Lesson 12, the income statement. In this lesson, we're going to see the income statement and its various components. This is the format of the income statement. The first item on the income statement is net sales. As you know by now, sales is accounted on an accrual basis, and therefore, net sales represents the money's worth of goods and services sold by the business, irrespective of whether cash has actually been received or not. Net sales, therefore, is the revenue earned by the business by selling goods and services. And it is the money earned and not the money received, because most businesses account for revenue on an accrual basis and not on cash basis. Let us go back to our example of the pizza shop. Let's assume that the pizza shop supplies pizzas every Wednesday to a specific customer, and it agrees with the customer to receive payment for the pizza supplied on the 15th of the subsequent month. So there are two aspects involved in this transaction. The first one is the sale that takes place on the Wednesday of every month, and the cash flow which takes place on the 15th of the subsequent month. So under the accrual concept, income is accounted on the date of the sale and not on the date of the receipt of cash. Similarly, net sales is the total sales made by the business minus the returns from the customers. So let's assume a business has sold goods worth $500,000 during a month. And let's assume there are returns from the customers worth $25,000. And therefore, net sales in this case is $475,000. The next item on the income statement is the cost of goods sold. Cost of goods sold represents the value of the goods sold to the customer. In the pizza shop example, cost of goods sold comprises of the pizza dough, vegetables, meat, cheese, electricity, and various other items that are involved in making the pizza ready. Going back to Joe's furniture factory, we saw that there are two major types of expenses. One is the cost, which represents the money spent to make the product, and the other one is expenses, which represents the money spent to develop, sell, manage, and account for it. So cost of goods sold in this case is the first component of this chart, which is the cost, and therefore is the money spent to make the product. Gross margin. Gross margin is one of the key financial indicators of any business. And gross margin is the difference between the net sales and the cost of goods sold. So this is the margin that a business adds up to its product before selling it to the customers. Next, under gross margin, you have 4 or 5 types of expenses. So this could be classified depending on the business into general and admin, sales and marketing, finance, and depreciation. General and admin represents expenses which are more of administrative in nature, like having an office, the rent, utilities, water expenses, electricity, and so on. Sales and marketing represents all expenses incurred by the business to market and sell its goods. So all the marketing expenses, the brochures, the advertisements all go into that head. The next head is the finance expense. Finance expense represents interest on borrowed capital. So if your business has borrowed money from a banker or a lender, then the interest goes into this head. And finally, we have depreciation. Depreciation is something that we covered in the fixed assets chapter of this course. Depreciation is the amount of wear and tear that an asset goes through during its useful life. That is also accounted as an expense. Finally, we have taxes, which are taxes paid to the government on the profits made. And the last item on the income statement is the net income, which is the money left over after all costs, expenses, and taxes. So the income statement is very simple. It starts with the sales, which is usually called the top line, and it ends with net income, which is usually called the bottom line. Summary: net sales is the money earned from selling goods or services. Cost of goods sold is the value of goods sold to the customer. Expenses are monies incurred to run, administer, and finance the business. And net income is what is left over after all costs, expenses, and taxes have been met.